Now we're going to cover section 2.2, the business operations. We will go through three main topics: the business plan, our budget, and the loan payment schedules. We will start from the fund structure. Imagine you are a fund manager and you found some good deals. Meanwhile, you have some investors approach to you. So you bring the money into the fund and bring the deal into the fund to form a limited partnership. So this is the fund you just launched and you are the general partner. So what we're going to do next is we're going to go through our business operations from a general partner standpoint. There are many different types of players in the fund industry. For example, fund administrators focus on the journal entries and the financials. So they generally just receive the receipt and the document from the general partners that they will prepare the document and the reportings for the client. So the clients are the general partners. Well, when we do this fund, I expanded this workflow a little bit longer. We start from the fund itself. This is the main part of our business plan. We will have a summary, an overview, and then this is the deals I mentioned earlier. And then we will have our capital cost schedules here, distributions, and we have our allocation and our strategy and exit strategy and a conclusion here. We will go through each part. So first of all, this is a made-up plan. My goal is to show different type of entries of business schedules. So we call this name the Good Practice Fund. It's a newly established investment fund designed to strategically and diversely invest across multiple business sectors. Our primary objective is to generate strong returns for investors by employing a balanced approach that includes full ownership, equity stakes, and strategic loans. The fund's initial capital will be allocated across a laundromat, an e-commerce business, an AI company, and a construction loan, creating a portfolio that balances growth potential with income stability. We make this fund relatively small to make it simple. I set up two equity investment and two loans to just diversify the type of investment to show different type of entries we're going to book, and all the numbers are just made up for reference. And we're going to have this overview of the fund. We're going to set this fund launch date, end of 2023. And right now we're going to make a 5-year closing fund. And we're going to have $50 million contributions and make a 15 to 20% target return. We make 7 investors here, 1 general partner and 6 limited partners here. And we do a 1% GP interest and 99% among 6 LPs. So in this situation, GP is one of the investors as well. There are situations that a GP is just the manager. They don't have any interest in the fund itself. So this is our fund stats, the fund overview here. And then this is our portfolio. For the laundromat, so this is relatively small. It's actually funny small. But I was just playing these numbers for the budget here. The yellow highlighted cells are input session. I was trying to play these numbers to make sure the year-to-date cash does not go to negative, because that is what you don't want to see. Then we are making this investment amount for the laundromat $800,000. This is a cash buyout to acquire full ownership of the laundromat. In real world, you could acquire a service company or manufacturing, a different situation. Here, I just make it simple because our fund size is very small. It's only $15 million anyway. And we do have a monthly income from the laundromat. It's $18,000. So these are the net profit generated annually from the operations. And we do like distributed monthly. And then we have this date of investment here. We have the exit date here. And our valuation 5x. So these are my assumptions. We will change around later to see how sensitive the fund level data will look like. And then this is estimated valuation when we exit this. And that is based on the monthly cash flow. And then we have expected return. So these expected return come from the IRR calculation based on the numbers we set up in the business plan. So the IRR table here, I have the date, the investment amount, and all the monthly. Actually, let me make it bigger. So you can tell I have all these numbers come from the business plan tab. And right now I have 35% return for the laundromat. If I change the number to be, for example, $1 million, and the IRR is 25.71%. This formula is to pick up the investment month. If the month here is the investment month, we will make the investment amount here. Otherwise, we will just pick up the cash flow. So now February is not investment month anymore. So now it's picking up the cash flow from the laundromat investment. So right now we're going to, once you open, you can tell for every single month until 2028, we do have the operation monthly income here. And by the end, we will have our last cash flow from the operation plus the exit proceeds. So this is how we calculate the IRR, including the cash inflow, $800,000 in the beginning, plus the ending proceeds. So this is how we get this expected return for this investment. And then we will have our AI tech companies. It's just made up company that we assume we're going to invest the $4.6 million and we will acquire 15% of the stake of the company. And we assume this is just a startup company. Most of the private equity funds focus on the investment with good cash flow. And the startup is more like for venture capitals. Here, I use this example just to diversify the different type of investment for us to book different entries. So this is just our game we're playing. That does not reflect a typical private equity situation. When I'm making this course, I could just make one investment of very similar type of investment, but I don't think it will fit the goal of teaching how to book different type of entries. That's why I diversify this a little bit to use different investment. Anyway, we will have our beginning dates in January and we will exit end of this year. Again, this is very short term. I'm making this short because I want to book a realized gain by the end of this year for education purpose. So this is not typical, but I just want to be able to show the realized gain, the entries. And then we will have evaluation multiple. Oh, this is not right. This should be 2x because eventually we'll just double the investment amount. This is made up valuation. Just random numbers I put in to be able to show a reasonable cash flow and to show some returns for comparison. For example, right now, this expected return is extremely big. This is just a help to identify the investment in the scatters. And this is good to show a good budget. Right now, for example, the first year, we have a positive ending cash flow every single month. But if I'm going to change, for example, let's just make it $5 million. We have very low return right now. And our budget will have a negative at some point. That's why I'd like to make this big to be able to show the impact. And then we'll have an e-commerce company. And in this e-commerce company, we're going to actually have 40% loan and 60% equity. And so this loan schedule would be here. We will have like a $4 million equity and a $2 million debt. And then we do have a dividend, quarterly dividend, and we will make the interest of the loan 8%. And then we make the term of the loan 3 years. And so right now we have our origination date, and then we have the maturity like 5 years later in May 7. And then we would have our expected equity proceeds. So this is the assumption again. And then the last one, we will just make it a construction loan. So this construction loan, we will have $3 million principal, and we will have 15% interest and make it 5 years, and we will make this loan prepaid. I hope you understand the reason I put this full investment here is just to diversify. We could have some investments with stable cash flow for the entire 5-year investment, and we could have some big good return investment with a very short term. And then we have an investment that will split equity and the loans. And then we have a pure loan investment that we get prepaid. So these are 4 pretty different investment. I just want to introduce different type of investment to walk you through how we treat this in accounting. And then we will have our capital call. So after we get an idea of how we're going to spend the money, now we're going to how we get all the money. So the fund will call the investment 3 times. Since our investment among different months. We will have our $1 million capital call in the beginning of the year. This is just an initial call to have the fund cover the operation cost. Then we're going to have the call to fund the loan one. So this is the $4.6 million to cover the AI company. So that's why we are going to have this investment in January 20. And then finally, we will have this call in May to cover the rest of the 3 investment. As I mentioned that we did 2 realization by the end of the year. So we will have our distribution schedule here. We are going to distribute the proceeds from the AI tech company, and we are going to distribute the prepaid principals from the apartment complex loan. And these are just made up numbers. We make the net proceeds like 20% of the growth. And this loan schedule is come from the proceeds from the loan. We'll come to the loan here. And then we will have this allocation. This is just a support of the schedule of the investment to show what's the allocation of the investment are. I add a little bit more details over here to explain why I use these 4 investment assumptions. And these are just the simplified investment plan activity and the strategy here. And then exit strategy here, again, these are made up. I made a 2 disposition within a year just for accounting purpose. And in real world, it will be much longer and we will have more investment in my next model when we expand our years. And this is a conclusion here. It's just a very standard language to show the model. Okay. This is important. This is my disclaimer. This is a hypothetical model and it's not related to my current work. It's a simplified model created for educational purpose. To tailor this course for my audience, the model covers most scenarios and entries commonly used in accounting. In future videos, I will address additional topics here.